Gold breaking decisively above the $5,200 level did not occur during peak liquidity. It did not unfold gradually over weeks of orderly price discovery. It happened in compressed time through thin conditions while much of the global market was inactive. At the same time, silver surged beyond $112 and the US dollar slid to its weakest level in 4 years. These moves did not arrive independently. They arrived together. And when correlated assets across metals, currencies, and rates reprice simultaneously under low liquidity, the market is not expressing enthusiasm. It is expressing stress. Before we go further, a brief clarification. There is no selling here, no paid signals, no fund. This is not advice. This is a real-time market briefing intended to explain what just happened, why it happened, and why it matters. What follows is not about predicting the next price. It is about understanding the signal. The first thing to address is the abnormality of the move itself. Gold does not typically establish new all-time highs in off hours unless something is forcing repricing. The market is signaling that existing reference prices were no longer sufficient to clear risk. This was not routine volatility driven by speculative positioning or scheduled economic data. It occurred during periods of reduced participation, when liquidity is thin and price impact is amplified. That matters because genuine price discovery prefers depth. When price jumps instead of trades, it suggests urgency. Someone needed exposure immediately, or someone needed to exit immediately, regardless of cost. In both cases, confidence in the prior equilibrium had broken down. Silver's move reinforces this interpretation. Silver is not a pure monetary asset. It is also an industrial input. When silver accelerates alongside gold, it often reflects a dual stress: monetary confidence on one side and physical supply pressure on the other. The speed of the move matters more than the level. Risk was repriced faster than the market could absorb it. Meanwhile, the dollar's decline was not driven by a single headline or a policy announcement. It weakened broadly against multiple counterparts, suggesting a loss of relative confidence rather than a bilateral adjustment. When the reserve currency softens as defensive assets surge, the message is not subtle. The market is not trading a story. It is reacting to conditions. This brings us to the geopolitical catalyst underlying the move. Capital does not seek safety in isolation. It responds to fragmentation, uncertainty, and the breakdown of assumptions that once anchored global flows. Over recent months, geopolitical risk has stopped being episodic and started becoming structural. Sanctions regimes have expanded, trade routes have been disrupted, resource access has become politicized, and monetary systems are increasingly entangled with national security considerations. When energy corridors, shipping lanes, and commodity supply chains become strategic leverage points, markets must reprice the reliability of future delivery. Gold and silver are not subject to export controls. They do not depend on permissioned settlement systems. They are not promises. They are assets without counterparty risk. The recent move reflects a reallocation away from political exposure. This is not about one conflict or one region. It is about cumulative instability. As blocks harden and cooperation erodes, capital seeks instruments that exist outside geopolitical alignment. Resource nationalism amplifies this effect. When producing nations prioritize domestic supply, restrict exports, or renegotiate terms, downstream economies face uncertainty. Industrial metals become volatile. Currency risk rises, and hedging demand increases. Safe haven flows do not arrive because investors are optimistic. They arrive because assumptions about continuity are breaking down. The market is signaling that geopolitical risk is no longer background noise. It is a pricing variable. That signal carries particular weight for the United States. Gold and silver do not move in a vacuum. They reflect pressure within the monetary and fiscal framework that underpins the U.S. economy. A weaker dollar alongside rising metals suggests inflationary expectations are being re-examined, not because inflation prints are accelerating, but because the tools used to contain them are being questioned. The United States remains dependent on complex global supply chains for industrial inputs, technology components, and energy transitions. Silver is embedded in electronics, solar infrastructure, medical devices, and defense systems. When silver prices reprice sharply, it transmits cost pressure through manufacturing and procurement channels. At the same time, fiscal dynamics are constraining policy flexibility. High debt levels limit the ability to respond to shocks without undermining confidence. Monetary tightening risks financial instability. Monetary easing risks currency debasement. The market is weighing these trade-offs in real time. The dollar's decline is not a collapse, but it is a message. It reflects declining confidence in stability at the margin. Reserve status is not binary. It erodes gradually through relative shifts in trust and utility. When capital hedges against the currency of the issuing sovereign, it suggests concern about future purchasing power, policy credibility, or both. This is not panic. It is repricing. To understand why these moves keep occurring, we need to examine market mechanics and structural stress. The distinction between paper markets and physical reality has widened. Futures contracts, derivatives, and unallocated positions dominate price discovery during normal conditions, but when stress increases, the question of delivery becomes relevant. Liquidity in paper markets is abundant during regular hours, when participants can offset positions easily. In off hours, that liquidity thins. Price becomes more sensitive to imbalances between buyers and sellers. If physical demand rises or available inventory tightens, paper prices must adjust rapidly to reflect that reality. Backwardation, delivery premiums, and exchange inventory drawdowns are not anomalies when viewed individually, but repeated dislocations suggest something more persistent. The market is struggling to reconcile nominal supply with real-world constraints. When price spikes occur outside normal trading windows, it often indicates that participants are unwilling to wait. They are responding to risk now, not later. This behavior reflects structural pressure, not speculative exuberance. The same dynamic applies to currencies. Dollar liquidity is deepest during U.S. hours. When the dollar weakens outside those windows, it suggests global repositioning rather than domestic reaction. None of this implies inevitability. Which brings us to the bear case. Volatility cuts both ways. Sharp moves invite corrections. History is filled with examples of metals surging only to retrace when liquidity returns and positioning normalizes. Intervention remains a risk. Policy communication can stabilize expectations. Forced selling can emerge if leveraged positions unwind. Liquidity events can reverse trends quickly. Margin calls do not discriminate between conviction and necessity. A strong move can overshoot and then correct violently. Ignoring these risks undermines credibility. Markets are not linear. They test extremes in both directions. Structural stress does not preclude tactical reversals, but acknowledging the bear case does not negate the signal. It contextualizes it. Which brings us to the strategic reframe. This event is not a prediction. It is a signal. It is not a guarantee. It is an early warning. The divergence between paper pricing and real-world pressure is widening. Confidence is being tested. Risk is being repriced. Gold above $5,200 and silver above $112 are not endpoints. They are reference points marking a shift in perception. The dollar's weakness is not collapse. It is erosion at the margin. Markets do not wait for consensus to change. They move when incentives shift. What we are seeing is a recalibration of assumptions about stability, liquidity, and trust. This does not demand action. It demands attention. Because ultimately, this is not about metals or currencies alone. It is about how capital responds when the structures it relies on begin to strain. This is your capital, your future, your responsibility. The first thing the market is signaling is that this move does not belong to normal volatility regimes. Gold does not accelerate through prior all-time highs under calm, liquid conditions unless the prior price was no longer sufficient to clear risk. What matters here is not only the magnitude of the move, but the context in which it occurred. This repricing unfolded during thin liquidity outside peak trading hours when participation is reduced and price discovery is fragile. That is precisely when forced signals appear. When markets move aggressively under these conditions, it is rarely because traders are confident. It is because someone is uncomfortable. Routine volatility is noisy. It oscillates around expectations. This was different. The speed of the move, the lack of retracement, and the synchronization across assets point to urgency rather than speculation. Gold, silver, and the dollar did not respond to a scheduled data release or a clearly defined catalyst. Instead, they adjusted abruptly, suggesting that an internal threshold was crossed. When markets behave this way, they are not debating probabilities. They are reacting to stress. Thin liquidity matters because it strips away the illusion of depth. During regular hours, large flows can be absorbed gradually by market makers and arbitrage desks. In off hours, that buffer disappears. Prices jump because there is no one willing to stand in front of the move. When bids vanish or offers pull back simultaneously, price gaps become information. They tell you that participants are unwilling to provide liquidity at prior levels. That is not enthusiasm, that is caution. The fact that gold led the move is critical. Gold tends to move last when confidence is high, and first when confidence erodes. It is not typically the asset of choice for short-term speculation during quiet periods. When it breaks higher under low participation, it suggests that holders of capital are prioritizing certainty over yield or growth. This is a defensive signal, not a risk-on one. Silver's participation strengthens the signal rather than diluting it. Silver is more volatile and more sensitive to industrial demand, but it is also thinner and more reflexive. When silver accelerates alongside gold, it often indicates that the market is repricing both monetary protection and physical scarcity. The move in silver was not incremental, it was abrupt. That tells us the adjustment was not about optimizing returns, it was about securing exposure. The dollar's decline completes the picture. Currencies usually move in response to relative changes in policy expectations or growth differentials. This move lacked that structure. The dollar weakened broadly without a clear trigger. At the same time, defensive assets surged. That combination rarely appears in benign environments. It suggests that the market is reassessing the reliability of the existing monetary anchor. Importantly, this was not a single asset misbehaving. Cross-asset confirmation is what elevates this from a chart anomaly to a macro signal. When metals surge, currencies weaken, and volatility increases under thin conditions, the market is communicating imbalance. Something is out of alignment between perceived risk and priced risk. There is also a timing element that should not be ignored. Moves that occur when fewer participants are active tend to reflect actors who cannot wait. These are not discretionary reallocations planned over weeks. They are responses to conditions that demand immediacy. In markets, urgency is usually driven by fear of being wrong-footed, not by optimism. This kind of price action often emerges when confidence in liquidity itself is being tested. If participants believe that future liquidity may be less available, or that future prices may gap further, they act sooner. That behavior compresses time. Price does in hours what would normally take weeks. Another critical aspect is the failure of the market to fade the move quickly. In routine volatility, exaggerated moves are met with counterflows. Here, resistance was limited. That implies that potential sellers were either unwilling or unable to engage. When sellers step back, it is often because they lack conviction in the stability of the prior range. All of this points to stress beneath the surface. Not panic, but tension. The market is signaling that the previous equilibrium no longer reflects current risk conditions, liquidity is being rationed, confidence is being tested, and price is adjusting accordingly. This does not mean the move must continue uninterrupted. Markets rarely move in straight lines, but it does mean that dismissing this as noise would be a mistake. When abnormal price action appears under abnormal conditions, it is usually because something fundamental has shifted. The key takeaway from this first signal is simple but uncomfortable. This was not a speculative surge driven by excitement. It was a defensive repricing driven by uncertainty. The market is not celebrating, it is recalibrating. The second signal embedded in this move is geopolitical, but not in the narrow sense of a single headline or a single conflict. Markets are responding to a broader structural shift in how power, resources, and financial systems interact. Geopolitical risk is no longer episodic. It is persistent, layered, and increasingly embedded in economic decision-making. That distinction matters because markets can usually absorb shocks. They struggle with chronic uncertainty. Over the past several years, the global system has moved away from integration and toward fragmentation. Sanctions have evolved from targeted tools into systemic instruments of policy. Export controls now extend beyond military hardware into technology, energy, and raw materials. Trade is no longer governed solely by efficiency but by alignment. This alters the flow of capital in ways that do not reverse easily. When access to markets, payment systems, or shipping routes can be restricted based on political considerations, capital seeks insulation. Gold and silver function outside those constraints. They are not claims on future performance or compliance. They are final settlement assets. In a fragmented world, that characteristic becomes more valuable, not less. This repricing reflects the market internalizing that geopolitical risk has shifted from tail risk to baseline risk. Conflicts no longer feel isolated. They overlap with supply chains, energy security, and currency arrangements. Investors and institutions are not reacting to the possibility of disruption. They are adapting to its permanence. Resource nationalism is a key driver in this process. Governments facing domestic pressure are prioritizing control over strategic materials. Mining licenses are renegotiated. Royalties increase. Export quotas tighten. These actions are rational from a national perspective, but they introduce uncertainty for global buyers. When access to physical resources becomes less predictable, prices must reflect that risk. Silver sits at the center of this tension. It is both a monetary metal and a strategic industrial input. It is critical to electronics, renewable energy infrastructure, and defense applications. As geopolitical competition intensifies, demand for these sectors rises, while supply becomes more politically constrained. The market is forced to reconcile these pressures in price. Gold responds to a different but related dynamic. As geopolitical blocks solidify, reserve diversification accelerates. Central banks in non-aligned or strategically cautious states reduce exposure to assets that can be frozen, sanctioned, or devalued through policy. Gold's appeal in this context is not ideological. It is practical. It cannot be repudiated or digitally restricted. The recent move suggests that this process is no longer gradual, it is accelerating. When large actors adjust reserves or hedge exposure, they do so quietly and often outside peak market hours. They are not seeking optimal execution, they are seeking certainty. That behavior leaves a footprint in price. Another layer is the growing weaponization of finance. Payment systems, correspondent banking, and settlement infrastructure have become instruments of policy. While effective in the short term, this strategy carries long-term consequences. It incentivizes the development of alternatives and increases demand for neutral assets. The market is beginning to price in that transition. Energy and shipping disruptions amplify these effects. When trade routes are threatened or insurance costs rise, the friction in global commerce increases. Inflationary pressure follows. Currencies tied to consumption-heavy economies become more vulnerable. Defensive assets benefit not because they generate cash flow, but because they preserve purchasing power in uncertain conditions. Importantly, this is not about an imminent collapse of the global order. It is about a gradual loss of predictability. Markets function best when rules are stable and enforcement is consistent. As exceptions multiply, risk premiums rise. That repricing does not wait for confirmation. It anticipates change. The simultaneity of the move across gold, silver, and the dollar suggests that participants are adjusting for a world where geopolitical alignment matters more than economic efficiency. Capital is being repositioned away from exposure to political leverage and toward assets that sit outside those systems. This does not require panic to be rational. It requires recognition. The market is not forecasting a specific event. It is acknowledging a shift in the environment. When geopolitical risk becomes structural, asset pricing must adapt. What we are witnessing is not a reaction to news, but a response to conditions. The market is signaling that the geopolitical backdrop has crossed a threshold where traditional assumptions about stability, access, and neutrality can no longer be taken for granted.